Welcome everybody, and today we are going to discuss about perquisites. Yes, salary part 2 is now ready for all of you. It took little more time actually for me to shoot this video because I was busy with lot of career orientation sessions for students after graduation and some exams from IIM Bangalore. But anyhow, the video is available, the notes are available in the description, so take the advantage of the notes and learn everything. Now after the completion of this video, you will have full clarity on everything about perquisites from the salary chapter. And if you have not watched the basics allowances, do watch that first and then come to this. So without waiting further, I am going to start with the perquisites. What is perquisite? Perquisite is the additional benefit. Arey, company pays you salary, money, right? In the name of allowances, they pay money. In the name of basics, bonus, commission, fees, they pay money, right? But beyond that, additionally something is given, we call it as perquisite. उससे ज़्यादा क्या? अरे बोलेंगे perquisite. What is it which is beyond that, which is more than that, additional, that is called as perquisite, which the employee gets. Now perquisites can be in cash or kind. Actually this is more of controversial statement, but I'll explain to you. Suppose the employer gives you the house to stay in, we'll call it as perquisite. Employer gives you car to travel, it is a perquisite. Employer gives you gas, water, electricity for free, it is a perquisite. So we understand that perquisite is in kind, right? But sometimes what happens, you have a loan which you are not able to pay, but the employer pays that loan. So is it not in cash? So sometimes it can also be in cash. That's why we should remember that perquisite is a additional benefit than what the money is paid by the employer to you, and it can be in cash or in kind. Now suppose if perquisite is given to the employee, it is taxed under salary. If perquisite is given to your client in relation to business, then it is taxed under PGAP. And in all other cases, perquisite is taxable under the head income from other sources. If employer gives perquisite to non-monetary benefit to employee, taxed under salary. If it is given in relation to business, to the client, no employer-employee relationship exists, then it is taxed under PGAP. In all other cases, it is taxed under the head income from other sources. Hey, there should be some legal origin, right? If it is illegal, if you are supplying ganja, afim, charas, no, these are not perquisites, it is illegal. You have to remember that you as an employee had to do some work of the employer. For official purpose, you went to some place and employer reimbursed the traveling expenditure. This reimbursement of expenditure which is incurred for official purpose, it is not benefit to the employee, right? So that's why reimbursement of expenditure incurred for official purpose is not at all a perquisite. This also you should remember. Now we understood general things about perquisites. How many kinds of perquisites are there? Let's fatafat understand. First one, perquisite taxable to all employees. Second one, it is taxable to specified employees. Come on, remember, taxable to all employees, taxable to specified employees, and exempt for all employees. So what are the perquisites exempt to all employees? What are the perquisites taxable to specified employees? And what are taxable to all employees? Everything we'll discuss in this video itself. So don't miss the video. Totally listen whatever I am going to share in this video. Now, first thing, what are the definition of perquisite? That is given in section 17. Rent-free accommodation. What is rent-free accommodation? Employer don't pay you money to pay the rent. If employer pays you money to pay the rent, that is house rent allowance. But if employer gives you keys that you stay in this house, then employer is giving some benefit in kind, that is perquisite, and we call it as rent-free accommodation. Sometimes employer gives you rent-free accommodation, but employer charge you nominal amount. Then we call it as rent-free concessional accommodation. Sometimes there are some perquisites which are taxable only to specified employees. there are certain perquisites which are taxable only to specified employees. Now you may ask me, who is specified employee? Chalo, let's see the second page, you will understand. First one, director of a company is a specified employee. So basically whole time director, managing director they are talking about. So if there is a director of the company, then he is a specified employee, right? Second thing I am talking about, that if the employees holds more than 20% of the equity shares, what I am talking about, if the employee holds more than 20% of the equity shares, now not with his family, he and his wife together hold 20%, no, he is not specified employee. If he individually holds 20% or more shares, that is 2 equity shares, then only he is a specified employee. Sir, he holds 50% preference shares, no, he is not a specified employee. So the shares should be equity shares, and second thing, at least 20% he should hold that shares, then he is called as specified employee. He is working in the company, if he is working in the company. And the last thing, the salary of the employee is 50,000 rupees or more per annum. So who is a specified employee? I said three things: director of a company, second one holding 20% or more equity shares in the company, third one he is getting salary of 50,000 per annum or more than that from the company. If these three things are satisfied, or any one of the three are satisfied, such employee, now we are only talking about employee, such employee is called as specified employee. Now when I spoke about salary, 50,000 per annum salary, so salary includes all, everything, whether it is basic pay, DA, allowances, perquisites, any other taxable monetary benefits, non-monetary benefits, arrears of salary, advance salary, everything included, minus deductions under section 16. So you should remember like this: salary includes all minus deductions under section 16. So a proper taxable salary computation is done to decide the salary is less than 50 or more than 50,000 per annum, right? In practical life, no such confusion will be there, because अरे 50,000 per month किस per annum किसकी होती है भाई salary, right? Everybody will have more than that. So everybody is a specified employee in our language. Clear? Great. Now there are some perquisites which are taxable only to this specified employees. There are some perquisites which are taxable only to specified employees. What are that perquisites? So list is 5 items. First one, motor car, right? Second one, educational facilities. Third one, gas, water, electricity. Fourth one, sweeper, gardener, watchman. Fifth one, free transport facilities. These are the 5 items. Come on, remember with me. First one, motor car. Second one, educational facilities. Third one, gas, water, electricity. Sweeper, gardener, watchman is the fourth one. Fifth one, free transport facilities. Now, if you are just watching like this, as if you are watching a movie, eating popcorn, how will you remember? Arey, when I am shouting like this, putting all the energy, your energy also consumed in the same way. Such way you try to shout out with me to remember the topic. That's what the purpose is. You should see the notes, underline it, shout out with me, and by the end of the video, you will be super confident about the topic. Are you ready to come with the next topic? Yes. Obligations of the employer met by the, sorry, obligations of the employee met by the employer. What I said? Obligations of the employee. Like employee has to repay some loan, employee has to pay some credit card bills, employee has to pay some dues to the other person, hospital charges, something or the other. Employee's obligation it is to pay, but employer paid. So whatever employer paid is the perquisite to the employee. Clear? Yes. So we discussed 4 points. Fifth point. Sometimes the employer pays something for the assurance of employee's life. So a type of insurance, maybe medical, no problem. So that is taxable in the hands of the employee. But if it is fidelity insurance, if it is employee state insurance, or if it is group annuity insurance. What are the three I said? Group annuity, second one ESI, employee stock state insurance, third one fidelity. These three are not taxable. Suppose if the employer takes life insurance policy and employer pays life insurance for the employee, then it is taxable. If it is life insurance paid by employer on the life of employee, it is taxable, but the employee will get deduction under 80C. But the employee will get deduction under 80C. So are you able to recollect what I said? Yes or no? अरे जोर से बोलो, yes sir. So what I said, that if it is fidelity insurance, group annuity insurance, employee state insurance policy, then not at all taxable to employee. If it is life insurance, it is taxable to employee, but deduction he will get. In all other cases, if any amount paid by the employer for the assurance of employee's life or medical treatment, then it is taxable in the hands of employee as a perquisite. Sometimes employee becomes the competitor, such strength, such energy, such confidence he gets in the business. It's the right time to make such employee the partner owner by paying something called as, giving something called as sweat equity shares. What I said, sweat equity shares. So if any sweat equity shares are given to the employee, basically they are given at a concessional rate. Suppose some employee stock option plans are given to employee, they are given at a concessional rate. Then whatever the difference is there, that is taxable in the hands of employee. Suppose market rate is 100 and employee gets from the company at 20 rupees. 80 rupees is taxable in the hands of employee as a perquisite. And any other fringe benefits, chiller benefit, chote mote benefit, they are taxable in the hands of employee. Like example, interest free concessional loans, or free travel, tourism and accommodation, club membership fees, credit card facilities, right? Use of movable assets or transfer of movable assets, free food, right? This is list which you have to remember. So these are the items which are actually fringe benefits and they are taxable. Don't worry, this is just the list which I am talking about. In detail, will be talking about each and everything later on. So listen to the video carefully, and this is just the list. Just try to remember reasonably. Okay. Now we will see the exempted perquisites. Now when I talk about all other perquisites, exempted perquisites are automatically covered, right? So never ever we'll discuss about it in detail in this video. Anyhow, mobile recharges, internet bills paid by the employer for the employee, these are basically exempt. Okay, this you remember, and all others anyhow will be covered during the course of the lecture. Let's continue with how to value this. How to value question, right? I have to find answer. So how to value the perquisites, that we are going to discuss. So let's take one by one. So rent-free accommodation. That means the employer gave you accommodation to stay. Nattu kaka, काम कर रहे हो company में? Yes sir, I am working in the company. But where do you stay? Sir, we are thinking where to stay, we are confused. Arey Nattu kaka, why you take tension? Company has lot of flats. You take the keys of this flat and stay there. So Nattu Kaka as an employee got rent-free accommodation as a benefit. Now how to value? What is the taxable perquisite to Nattu Kaka? So let's discuss. If suppose he is a government employee. He is a government employee. In that case, what will happen? Whatever license fees fixed by government, right? Whatever license fees fixed by government, right? That is taxable to Nattu Kaka as rent-free accommodation perquisite. But suppose the employer is not government, then Suppose if the employer is not government, then I will tell you, if the government, it is not government, then it is non-government. So what? So the employer hired the accommodation and gave to employee, one option. Or the employer has his own accommodations or flats which he gave to employee. What is the actual situation? So suppose if it is hired by employer and given to employee, then what to do? Then I will say the value of perquisite is either 15% of salary or actual higher charges paid, whichever is lower. So suppose if the employer is non-government and the accommodation is hired by employer, right? I am stressing on the word, okay? Then the value of perquisite to employee is 15% of salary or actual higher charges, whichever is lower. Next, if suppose the accommodation is owned by the employer, right? There are many companies, right? Reliance is there, they may have lot of accommodations to be given to employees, right? So in that case, how to value, right? They are not paying anything outside to decide. So how to value? So government said, let us decide on the basis of population. If the population is less than 10 lakhs, 7.5% of the salary. If the population of that area is between 10 lakhs to 25 lakhs, 10% of the salary. If the population is more than 25 lakhs, 15% of the salary. Are you clear? So what are the three percentages covered? 7.5, 10 and 15. So if population is less than 10 lakhs, 7.5%. Population is between 10 lakhs to 25 lakhs, then 10%. More than 25 lakhs population, then 15%, right, of the salary. So this is the value of rent-free accommodation. Now suppose, if suppose employer recovers some small amount from the employee. So whatever value we got till now, right, the value of unfurnished accommodation, because did we talk about furniture? No, right? So unfurnished accommodation value we determine. If employee pays back to employer something, that value of perquisite minus recovered from employee becomes the actual taxable value of perquisite. Clear? If the value comes to around 70,000, employee paid 10,000, so 60,000 is the net value of perquisite, correct? Because 10,000 worth benefit is already paid back, right? That's why. So whatever value determined till now minus paid by employee to employer will be the taxable perquisite. That's it. Next thing. Suppose example, if furniture is also allowed. TV, sofa, fixtures, gas, electricity, geyser, fridge, washing machine, सब कुछ employer gave. Everything employer gave to the employee. Now what should be the value of perquisite of this furniture? You tell me. So let's divide these all into two parts. One, is it hired? If these are hired by employer and given to employee, then whatever higher charges are, that is the value of perquisite. If this furniture is owned by the employer, then 10% of the cost. What I said? 10% of the cost. What I said? 10% of the cost. Don't confuse with WDV. Here I said cost means cost. That's it. दिमाग नहीं लगाना मेरे दोस्त. मैं जानबूझ के स्ट्रेस कर रहा हूँ. आई एम स्ट्रेसिंग ऑन समथिंग मोर. थोड़ा सा कर्कश भी लगता हूँ. यू मे फील फ्रस्ट्रेटेड. अरे इतना जोर से क्या चिल्ला रहा है. बट टू रिमेंबर कि cost means cost. That's it. Okay, let's continue further. If here also employee pays something, then deduct it from the value of perquisite. So first will come value of unfurnished accommodation plus value of taxable value of furniture. These two will be totaled and shown in the salary computation, which we discussed in the first lecture. If you have not watched, please Okay. Next story. Now we understood that if the accommodation is provided by employer, all that is okay. But what if the employer gives accommodation in a hotel, right? That we have to discuss. Before that, let us discuss the salary definition. I forgot just, so I am recollecting. Salary is equal to salary for rent free accommodation. Now this definition of salary use here only, right? So what is salary? Salary is equal to basic pay, DA retirement. Now when it comes to CMA exams, if they simply gave DA, still consider that it is DA retirement. Okay? If they say DA not forming part of retirement benefit, then don't take that DA. Okay? Only that DA which is normally mentioned or mentioned that forming part of retirement, you take such things. If they specifically mention that DA not forming part of retirement benefit, don't take it. So basic pay, DA, commission, bonus, fees, right? All that should be taken. Then all taxable allowances you take, right? Everything you should take. But don't take perquisites. Whether it is monetary perquisite or non-monetary perquisite, don't take. Okay? Employer's contribution to provident fund. What I said? Employer's contribution to provident fund. Don't take it. So what are the two items I said don't take? Perquisite, any perquisite value don't take. Second one, employer's contribution to provident fund. Third one, arrears of salary. Fourth one, advance salary. These are the items which you should not take while computing the value salary for the purpose of rent free accommodation. Now why we should calculate salary separately here? Because based on population 7.5, 10%, 15% we discussed till now, right? Their salary into that percentage should be done. For that purpose we are doing it here. Salary should be taken on accrual basis. Salary how it should be taken? On accrual basis. Salary कभी भी कैसे लेना? Accrual basis पे लेना. Right? That's what we discussed. Let's come to hotel now. If accommodation is given in hotel, simply remember, if it is up to 15 days, how many days? Up to 15 days, not a taxable perquisite. What I said? Up to 15 days, not a taxable perquisite. But beyond 15 days in a hotel, then least of the following two. What are they? 24% of salary or higher charges of hotel, whichever is lower will be the value of perquisite. What I said? 24% of salary or higher charges paid, whichever is lower will be the value of perquisite. Whichever is lower will be the value of perquisite. So are you clear? If accommodation is given in hotel, up to 15 days not a perquisite, but beyond 15 days 24% of salary or higher charges, whichever is lower will be the value of perquisite. That's it. Clear? Now what should be the salary for this? Same discussed, right? Basic pay, DA, retirement, commission, fees, bonus, all taxable allowances, but don't take perquisites, don't take employer's contribution to provident fund, don't take arrears of salary, advance salary. That's what I want to convey and repeat for you. But suppose sometimes what happens, suppose you are a family person who have kids, schooling, education, something like that, and then you are suddenly shifted to some other location, but you can't stop children's education in between, right? During the academic year in between you cannot stop and shift to other school in other area, right? But because job requires, you have to shift. So in that case, the employer may give you two accommodations. One existing, where you, your wife, your children are staying, and the new place where you have shifted for job. So if two accommodations are maintained, then how to value? The answer is first 90 days. First 90 days. You have to value the perquisite of both the houses and whichever is lower, that you actually tax, right? Whichever is lower, that you actually tax. So in simple language I am telling, government gave you an option, choice, that one can be exempt. Government क्या दिया आपको बेटा, एक choice दिया कि एक घर exempt है, one house exempt. That means now which house exempt? Whose perquisite value comes more, that you will consider as exempt. But what is more, what is less, how to decide? So value the perquisite of both the houses. Whatever comes more, take it as exemption. Whatever comes less, what will you do? Tax it. Sir, how to determine perquisite value? As discussed earlier, right? If it is government license fees, if it is non-government hired, then 15% of salary or higher charges, whichever is lower. If it is non-government but property or house is owned by the employer, then population less than 10 lakhs, 7.5% of salary, population between 10 lakhs to 25 lakhs, 10% of salary, population above 25 lakhs, 15% of salary. That valuations we did, right? Accordingly only you should value and decide which you have to exempt and which you have to tax. Higher is there, take exemption. Lower value is there, tax it. That's it. But sir, what about after 90 days? After 90 days, both are taxable. After 90 days, both the properties will become, or both the accommodations become taxable. But suppose you are shifted on a temporary basis to any remote area, or to an area which is something like oil exploration, or something like power generation site, mine sites. Yeah, if you think about that power generation site, mine site, मैं भी भूल गया यार, and project execution site, or onshore, offshore, oil exploration site, some things like this are there, na? In these areas, if temporarily it is given, then, अरे यार, you don't have facilities there, right? So how can you ask them to tax, pay tax on the benefit? It is not benefit. It is some suffering. You have to work in such area with such difficulty. So that's why government said, if you are working in such sites like mine site, power generation site, onshore, offshore sites, or if you are working in some sites like माइंस, सब भूल जा रहा हूँ यार बार बार, है ना? चलो कंटिन्यू करते. विच इज जस्ट more than 8 kilometers away from the municipal limits. What I said? Which is more than 8 kilometers away from the municipal limits. So municipality, local authority limits are there, na? From that limits, at least more than 8 kilometers away, if they are, or if it is a remote area, then these rules will not apply. That means if the employee's family stays in city and the employee stays in such a remote area, such on-site, such a power generation site, government says, okay, we will not tax the second site, right? Second site, which is that power generation site, will not be, the accommodation at that place will not be taxed. Only the family wherever they stay, that only will be taxed. Clear? That's it. You have to remember like this to understand each and every topic. Okay? We already discussed who is a specified employee, right? You all remember who is specified employee? Who is a director of the company whose salary per annum is more than 50,000 after deductions. That is only section 16 deductions I am talking about. And or he holds 20% or more equity shares in the company. If any of the three criterias are met, he is a specified employee. And to such specified employee, motor care facility, or we can discuss about a free education facilities, transport facilities, or we can discuss about gas, water, electricity, sweeper, gardener, watchman, personal attendant. These are the facilities which are taxable to only specified employees. That's what we discussed. Now a more detailed analysis we will try to do in each and every matter. So are you all ready? Yes or no? So I feel you are all ready. Let's start with the discussion. First I will discuss about motor car. क्या motor car. चलो घूमते हैं कार में मस्ती करते हैं. Right? So if suppose if the car is of the employer, car किसका है? Employer. Given to employee. And all the expenses are also met by the employer. Now let's remember whose car and who is spending. These two are important words. Okay, if it is employer's car, employer is spending, and usage is for official purpose. Like example, Mahindra Resorts is there, so somebody comes to market Mahindra Resorts, then in that case it is just for official purpose. The marketer cannot come on a bike or a Luna because the prestige is there. Who will pay for Mahindra Resorts? Only the rich people. So that dignity should be maintained. So that's why cars are given to the employees many a times to crack the deals, to meet some rich people, higher officials. Cars are given to the employees. So anyhow, we'll not get into detail. If car is of the employer and amount spent is also by employer and it's used for official purpose, then it is not a benefit to employee, right? Not at all a benefit. So what is the value of perquisite? Nil. If suppose car is of the employer and all the expenses are paid by employer, but it is for the personal benefit of employee. Personal benefit of employee. अरे यार नई नई शादी हो गई, जा घूम के आ, मस्ती करके आ. So personal benefit of employee. Then in that case, whatever actual expenditure is there for petrol, maintenance, whatever actual expenditure for driver, that is chauffeur we can use in this income tax language, chauffeur driver, and third one is 10% of the cost. These three together become the value of perquisite. So what I spoke to you now, just a recap. So if the car is of the employer, used by the employee for personal purpose and amount also paid by employer, then whatever actual amount is there, right, spent on petrol plus driver plus 10% of the cost as depreciation, these three together will become the value of perquisite. But if suppose car is of the employer, third case I am discussing, and expenditure is incurred by employer only, but partly personal, partly official purpose. What I said? Partly personal, partly official purpose. Then we have to see whether it is big car or small car. If it is big car, then 1800, 2400 per month, and if it is small car, 1800 per month. What I said? If it is big car, 2400 per month, and if it is small car, 1800 per month will be the value of perquisite. If driver is also given, then 900 per month for driver, right? Whether it is small or big, driver's salary, driver's value of perquisite will not change. So again I am talking about whose car? Employer's car. Who spent the money? Employer. Use partly personal, partly official. In the day office work, after in the evening personal work. So if it is like that, then if it is big car, 2400 per month, if driver is there, 900 extra per month, okay? And if it is small car, 1800 per month, and driver is there, 900 extra per month. Then how to decide whether it is small car or big car? If the capacity of the engine is 1.6 liters or more, then it is always big car. If the engine capacity is less than 1.6, it is small car. Hardly we can find some small cars now, right? Yeah. This is how you should understand. But suppose if the car is of the employer, fourth case, and amount is spent by the employee, partly official, partly personal, right? Here there is a small change. Who spent the money? Change it, right? So employee spent the money. So if it is car of the employer, amount spent by employee, partly personal, partly official, then 900 per month for big car, 600 per month for small car per month I said, and driver 900 extra in all the cases if driver is there. Okay. Remember this. So whose car? Employer's car. Who is spending money? Employee. Purpose? Official, partly personal, partly official. Then how much? Big car 900, small car 600, driver is there, extra 900 per month. Remember this. This is the value of perquisite. Lot of problems we have solved in the class, right? Now, if the car is of the employee, fifth case, and payment is done by employer for official purpose, fully exempt, right? कोई benefit नहीं है ना employee को, no benefit to employee, right? Now, if car is of the employee and amount paid by employer, but partly personal, fully for personal purpose of employee. So car of the employee, but payment done by employer for personal purpose of employee. Then whatever actual amount paid by employer, that will be the taxable value of perquisite. Now come to the next story. If it is car of employee, but amount paid by employer, partly personal, partly official, then what should be the value of perquisite? Simple. Actual amount paid by employer minus, if it is big car 2400 per month, small car 1800 per month, and driver is there, then 900 extra you deduct, no problem, per month. Clear? So these are the 7 cases which you should remember. Compare, analyze. You have to ask certain questions before solving the answers. First, whose car? First question should come in your mind. Whenever you see motor car problems, whose car? First question. Who is spending the money? Second question. And for what purpose it is used? Third question. If these 3 questions are clear, then no problem, you will not do mistake while solving the problems. But if you don't ask these questions to yourself, then always remember official is fully exempt, irrespective of whatever the case may be. Official is fully exempt and personal is fully taxable. Easy, right? No doubt. Only thing you have to remember is partly personal, partly official, what to do. And I feel you remember now. Correct? Now, suppose if it is not motor car, but it is other car. Suppose a van is given. Suppose a bus is given. Right? Suppose if it is a bike given to the employee, then what? Please remember, if it is official. So I don't want to waste your time in revision and try to make you remember in much sequential way, but it would be complicated in long run. So simply remember, if it is other vehicle, if it is for official purpose, fully exempt. If it is for personal purpose, then whatever amount paid by employer is fully taxable. But if it is partly personal, partly official, then if the car is of employer and expenditure also incurred by employer for partly personal, partly official, you have to create a ratio, right? How much proportion for personal, how much for official. That personal proportion will be fully taxable. Official will be anyhow exempted. So when I said partly personal, partly official, I was talking about employer's car spent by employer for partly personal, partly official. Create a ratio of personal and official. Personal will be taxable, official will be exempt. But if suppose car is of the employee and spent by the employer for partly personal, partly official, whatever the employer spent minus 900 per month will be deducted, 900 will be deducted and balance will be taxable. No sir, 900 is too less. Okay, then you claim higher amount, deduct it and the balance will be taxable. Okay, clear? No confusion? Right. Now suppose if the employer gives 2 cars, 3 cars, 4 cars, 5 cars, any number of cars to the employee, then the first car will be treated as if it is partly personal, partly official. First car will be treated as if partly personal, partly official. And from second car onwards, second, third, fourth, all will be treated as fully personal. So first car is partly personal, partly official, and from second, third, fourth, whatever cars are there balance will be treated as fully personal. Now how to consider which car should be partly official, partly personal, and which car should be totally personal? We have to judge, right? So I will tell you that if in the question they tell that this car is used only for personal purpose, then let it be for personal purpose. Don't analyze now. Okay? Other cars you have to check that, take one car as partly personal, partly official, and other as personal, and then calculate. Then do the reverse. What was partly personal, partly official, treat it as personal, and then what was treated as personal, treat it as partly personal, partly official, and then calculate. In simple language I am telling that because you have a choice to decide that what should be partly personal, partly official, and what should be personal. One car you have to decide to be partly personal, partly official. So you have choice. So when you have choice, you will value the cars in multiple ways, right? And wherever the tax, the value of perquisite is less, that you will consider. What's wrong with it? Suppose I have car 1, car 2, car 3, and in car 3 they gave personal only. Then you have left with only two options, car 1, car 2. Now first option you create like this, that first car is partly personal, partly official, second is personal, and third is anyhow personal. And then value and calculate what comes. And come to option 2, right? First we will consider personal, second partly personal, partly official, third will be anyhow personal. And then value. Wherever the value is less, right, that option is better because you ultimately want to save tax and pay less. Correct? Now, suppose, sir, a car is given for a part of the month. Please ignore part. When we value motor car, we only consider total months. Part months are ignored for this purpose. Part months are ignored for this purpose. Now, point number 2 in the note I am talking about now. Suppose you want to show to the government that whatever value as per these rules come, they are actually more value. I am asked to pay tax on higher value of perquisite. It is unfair. Government says, come, we want to listen to you. Come with the documents. Show for official purpose from which place to which place you traveled, on which date you traveled, how much mileage the vehicle gave, all that documents you prepare. Come and please you sign it, stamp it from your employer, come to us, we are ready to value it and give you the right benefit. We don't want to unfairly tax you. That's what the government says. But come up with documents, that's what important. And come up with documents for official purpose only, right? Personal, government is not asking you, because balance time period is only for personal, right? And personal you can write whatever you want. Official, government can have a track because stamped by employer. That's how things operate. Now once we completed this motor car facility, let us come to the next point, and that is we are going to talk about education is there, gas, water is there, but first let's discuss about sweeper, gardener, right? Sweeper, gardener, watchman, personal attendant. What I said? Sweeper, gardener, watchman, personal attendant. Now this is also taxable to specified employees. But if suppose these are appointed by the employee and paid by employee, then what the employer has to do? Nothing. So it is not taxable, right? Employee appointed, employee paid to this sweeper, gardener, nothing taxable. But if employee appointed, employer paid, what I said? Employee appointed, employer paid, then what to do? Then whatever actual cost whatever employer pays will be the taxable value of perquisite to all the employees. To all the employees. To all the employees. When if it is appointed by the employee and paid by employer, whatever actual cost is there, that is taxable to all employers. Please remember, all employees. If suppose appointment and payment both are done by employer, then whatever actual cost is there, that is taxable only to specified employees. So taxable only to specified employee when if it is appointed by employer and paid by employer. And what is the value of perquisite? Whatever paid. Right? Now, if suppose employee repays to the employer something, employee repays to the employer something, that you have to deduct while valuing the perquisite. Okay? Same way, gas, water, electricity also. Okay, wait. One more point. If suppose, two more things I'll tell you. If suppose there is an allowance, sweeper allowance, gardener allowance, watchman allowance, that is anyhow fully taxable. So no rules will apply for allowance. They are taxable. Right? If anything employee has already paid back to the employer, that should be deducted from the value of perquisite. This also you should remember. But suppose, one more thing which I am not given in the notes but you have to write down, which I will share with you now, that if suppose employee gets rent-free accommodation from employer, what I said, employee gets rent-free accommodation from employer and gardener is appointed by the employer. Employee gets rent-free accommodation and gardener is also appointed by the employer. Then the gardener will never be taxable to the specified employee. Gardener will never be taxable to specified employee. Only if rent-free accommodation is given by the employer and gardener is appointed by the employer. Then it is normally taxable to specified, right? But in this exceptional case, no, it is not taxable. What about gas, water, electricity? Let's recap fast. Come on. If it is employee, actually the bill is in the name of employee. Then if it is the employer's own product, then manufacturing cost. Employer also takes from other and give. Then it is taxable to then the actual cost. Okay. Suppose example, you are working in HP gas and some HP gas cylinders are given for as free of cost to you. Then what will happen? Then if you are a specified employee, then it will be taxable to you if it is in the name of the employer. If it is in the name of the employer, it is taxable to specified employee, and if the bill or the cylinder is in the name of employee, then taxable to all. So in the name of employee it is, the bill is in the name of employee, taxable to all. If bill is in the name of specified, bill is in the name of employer, taxable only to specified employees. If it is employer's own product like HP gas company giving cylinders, then it is manufacturing cost. If it is the not employer's product, then whatever employer paid to the company to purchase that, that will be the value of perquisite. If anything recovered from employee, then that obviously should be deducted. If there is allowance like gas allowance, water allowance, then it is fully taxable. Allowance is taxable, no question about it. Okay, shall I go to the next thing? We discussed three things: motor car, second one is gas, water, electricity, third one is servant, sweeper, gardener, watchman, right? Three things over. Fourth and fifth, which are taxable to specified, where specified, non-specified categories come. So fourth one which I am going to discuss is educational facilities. Educational facilities given by the or paid by the employer for the employee's children, paid by the employer for the employee's children. Okay, no problem. Where? If it is employer's school, whatever cost to employer minus 1000 per month, minus 1000 per month, minus recovered from the employee. Please remember, if it is employer's own school and education facilities are given to employees' children, then cost to the employer minus 1000 per month and minus recovered from employee. But if it is in other school, not employer school, then cost to the employer minus recovered from employee. No confusion should be there. And if it is not children, but any other family member, then in all the cases, remember, cost to the employer minus recovered from employee. And when I talk about children, it is always even adopted child, stepchild is included, but illegitimate child is not included. And what is the limit on children? 2 children, right? Absolutely no. You can have a cricket team, no problem. Everybody, for all children, this facility is given. Okay? Right. Wonderful. Now I want to discuss with you, suppose the employee paid the school fees to the school and employer reimbursed it, then it is fully taxable. Right? If employee pays to school and employer reimburses it, then it is fully taxable. But if employer gives education facility in his own school or employer pays to the school in which the child is studying or family member is studying, then only these rules will apply. And always remember, it is taxable to only specified employees. Right? Now, you have to remember certain things, that if transport facilities are given to transport employees, suppose airlines employee get air tickets, airlines employees get air tickets for free, then it is fully exempt. Railway employees get railway tickets for free, fully exempt. But what about other transports like shipping, road transport? What about that? So whatever is charged to the normal public, that will be the value of perquisite, but minus recovered from employee. Minus recovered from employee. Now this is taxable to specified employees only. Okay. So what I said, please remember, whatever charged to the general public minus recovered from the employee, that is a taxable perquisite. If suppose example TSRTC is there, Telangana State Road Transport Corporation, gives transport facilities free to its employees, is it exempt? No. If the employee is specified employee, it is taxable. But what is the taxable value of perquisite? Same as it would have been to a normal person. What was the fare? That minus recovered from employee. And please remember, transport allowance we discussed, right? To transport employees, how to treat, right? Whatever transport allowance received, minus 70% of allowance or 10,000 rupees per month, whichever is lower, right? 10,000 per month or 70% of allowance, whichever is lower, will be deducted and balance is taxable. This we discussed about transport allowance. So transport facility and transport allowance both are different. Don't get confused. Okay? Transport facility, tickets given to airlines and railway employee fully exempt, other employees taxable, minus recovered. Right? With this we understood allowances, perquisites taxable to specified employees. Now we will discuss about sweat equity shares, employee stock option plans. Sometimes what happens, the companies give to the employees some shares or some securities, so that the employee gets motivated to get work, feels the ownership in his mind, so that he contributes more to the organization. Whenever Vivek Bindra says that whenever employee becomes so competent that he can become your competitor, then it's the time to make him the partner, make him the owner by giving some sweat equity shares. Now, if sweat equity shares or ESOPs are given, some shares or securities are given from the employer to the employee, either for free or for concessional rate, then income tax says, hey, we are here. It is a taxable perquisite. Now, suppose 100 rupees market value share and it is given for 30 rupees only to the employee. Then 100 minus 30, 70 will be taxable perquisite. Okay, 30 rupees is in the agreement. What is the amount which the employee should pay? But how to decide the fair market value? Fair market value, and when to decide the fair market value? Like when company gives the offer, right? Or when the employee exercises the option, or when the shares are allotted. When students get confused with the number of dates and the fair market value, never ever think. Your focus should be like Arjuna, one point focus, and that is the fair market value on the date of exercise of option. क्या बोला मैं, याद रखो बेटा? Fair market value on the date of exercise of option. क्या बोला मैं? Fair market value on the date of exercise of option minus whatever employee paid will be the value of perquisite to the employee. Clear? Now let's come forward. What I wanted to speak further is that if this is the value, what about companies which are listed in the stock exchange? Right? Continuously the price fluctuates, right? That's why government said no problem, the morning price, opening price plus closing price divided by 2. What I said? Opening price, closing price on the date of exercise of option divided by 2. Let us take the value. But sir, our shares are listed on BSE, NSE both. Oh, your shares are listed in multiple stock exchange. Then on which stock exchange the trading happens more? For your shares. For your shares, on which stock exchange more trading happened? That stock exchange opening price plus closing price of your share divided by 2 will be considered as the fair market value. Okay? Right? No confusion, I feel. Now, when it is taxed, as and when you exercise the option in that previous year, it becomes your perquisite. But suppose there is a new startup. Generally, what will be done? The year in which you actually exercise the option will be considered as the year of earning income and you will be asked to pay the tax. But actually, did you get money? No, right? You did not get money, still government asked you to pay tax. Yes, this happens. But when some people went to government, asked, sir, this is our startup and we don't pay more salaries to employee, but our main motto is to give sweat equity shares so that their wealth becomes more. Salary wise we don't pay much. Now if such employees who are getting some shares are asked to pay some good amount of taxes because they have less cash, it is practically difficult. So give some benefit, some exemption to startups. This was asked by the people to the government, industry to the government. Government said tathastu, okay. So when these people should pay tax? Within 14 days. When they should pay tax? Within 14 days. Now within 14 days from which date? If they sold the shares from the date of sale. If suppose the business is closed or the employee left the job, from that date within 14 days. If the shares are sold, from that date within 14 days. If the company is closed, from that date within 14 days. If the employee leaves the company, from that date within 14 days. If nothing of such things happen, then still government should get the amount of tax within reasonable time, right? So they said within 48 months from the end of the within 48 months from the end of the assessment year. Suppose your previous year is 21-22. Your assessment year is 2022-23. That means till 31st March 2023. Your assessment year ends. Now 23-24, 24, 25, 25, 26, 26, 27. Again I am telling 23, 24, 24, 25, 25, 26, 26, 27. Till 31st March 2027, 48 months are over. Array, each year 12 months are there. 4 years means 48 months, correct? So till 31st March 2027, it's over. From that date, within 14 days. So not 14th February, 14th April. 14th April 2027, you are considered to have earned the income. And accordingly, you have to pay the tax. So government deferred it like this. And it is based on situation. If you sold the shares within 14 days from the date of sale, if you closed the business is closed from that date within 14 days, if you have retired from the job within 14 days from that, if nothing of such things happen, from the end of the current assessment year, when you exercised the option, if you exercise the option in 21-22 year, then till 21-22 is your previous year, 22-23 is your assessment year. From the end of the assessment year, that is from 31st March 2023, calculate 48 months. That comes to 48 months means 4 years. That comes to 31st March 2027. And from that date, within 40 days, your income is considered to have earned, and in that previous year your income earned, so accordingly you have to pay the tax. That's it. We completed this. Now we will discuss about interest free concessional loan. Suppose if the interest free concessional loan is given for medical treatment of cholera, dengue, cholera is there, or cancer is there, AIDS is there, some severe diseases, then interest free concessional loan not a taxable perquisite. If the loan given by employer to the employee is just up to 20,000 rupees, not a taxable perquisite. But other than these two cases, it is taxable perquisite. Okay, but how to calculate and what should be the base? So they said State Bank of India interest rate on first day of the previous year. What I said? State Bank of India interest rate on the first day of the previous year. What I said? State Bank of India interest rate on the first day of the previous year minus whatever interest paid by the employee will become the taxable perquisite. Will become the taxable perquisite. Many a times you would have seen that every month not only interest but principal will be paid. So obviously every month the interest will decrease. So if it happens, then calculate month on month basis, no problem at all. But please remember, interest rate, standard rate which will be considered is SBI rate on 1st April of the previous year. Minus whatever interest paid by employee or not paid by employee will become taxable perquisite, and you calculate considering this rate on each month basis if every month principal is paid. That's it. Okay. So we completed something called as shares. We completed interest. Now let us discuss about traveling, tourism and accommodation. Traveling, touring, accommodation. What to do? Suppose example you went on official tour. And if you are on an official tour and you spend something on official tour, then anyhow it is fully exempt. Right? But suppose if for traveling, tourism, accommodation, if employer pays to all the employees on a uniform basis, that means everybody gets the similar type of amounts, then whatever employer pays minus recovered from employee is taxable. Whatever employer pays minus recovered from employee is fully taxable. Now officially is fully exempt. I am talking about personal. If uniformly all employees get, then whatever employer paid minus recovered from employee, balance is taxable. But if suppose the employer pays ununiform, not uniformly, right? Employee to employee the amount paid is changing, then government says no problem. If same type of traveling tourism a normal public do, what actually the payment they had to make. That means simply fair market value minus recovered from employee will be taxable perquisite. Okay. If it is uniform, whatever employer pays minus recovered from employee. If it is not uniform, then whatever market price, whatever public pays for similar transportation minus recovered from employee. No doubt should be there. Right. Next thing let us discuss about. So we completed three things. First, second, third. Now free food we have to discuss. Generally, if example you are working at an office and you are getting something called as tea, fully exempt. If you are getting snacks, fully exempt. Are samosa, kachori, right? If you get fully exempt. But if suppose you are getting meals, then whatever cost of meal minus rupees 50 per meal minus recovered from employee. Suppose cost of meal is 100 minus 50. So balance 50. Recovered from employee suppose 10. Then 40 will be taxable per meal. So suppose 30 meals in a month. So 40 into 30 taxable. This way you should calculate. But if suppose the employee is working in onshore, offshore oil exploration project sites, something like that, then even food is fully exempt. Okay, clear? So simply remember what I talk about: food, snacks, tea, fully exempt. Food during office, taxable, but how much? Whatever cost of meal minus rupees 50 per meal minus recovered from employee is taxable. But if it is on site, oil exploration project site, then or mine, then fully exempt. Even food is fully exempt. What about credit card and club membership fees? Combinedly I will talk about. Whatever amount paid by the employer minus for official purpose minus recovered from employee. Please remember. Suppose credit card bill is 1 lakh rupees and out of that 60,000 is for official purpose. Employee paid 10,000 rupees back to the employer. So that means 1 lakh minus 60 minus 10, 30,000 is taxable perquisite. Same with club membership fees too. Okay, very good. So only personal portion is taxable, that's what they want to tell. But in club, there are certain more items to remember. Suppose entry fees is paid by the employer, then it is not taxable to employee. If club is for employer's business purpose, then not at all taxable to the employer. For maintaining business connection and all, not taxable to employee. If it is sports club, gym club, health club, then it is not at all taxable to the employee. Okay, are you able to connect? Very good. With this we understood so many. Now let us discuss about gift. Suppose example, you are doing a job in a company and your employer is so happy he gave you some cash gift. Now income tax says, hey, fully taxable, right? So income tax will say that if you receive any cash gift, it is fully taxable. But if it is a gift of movable property, like example, your boss is so happy that he has given you a diamond ring as gift worth 2 lakhs rupees. So nice, right? But income tax says, hey, up to 5,000 exempt, balance 1,95,000 is taxable perquisite. So whatever the fair market value of the diamond ring, suppose 2 lakhs minus exempted amount 5,000. So how much? 1,95,000 becomes your taxable perquisite. Now come to use of movable property. Employers give you laptops, computers to work on. Now if they give laptops and computers, it is not at all a perquisite because it is a requirement of the work. But suppose other than laptop and computers, anything is given just for usage, right? Not permanently, just for usage. In that case, 10% of the cost, 10% of the cost will be considered to be the value of perquisite in the hands of employee. Okay. So what about if the employer gives certain assets permanently to the employee? In simple language, we can say it is transfer of movable assets, correct? Right. If it is computers, then how we should value? If it is motor car, then how we should value? And if it is other assets, how we should value? The answer is very simple. First, take the actual cost to the employer minus deduct the depreciation for how many years the employer used it, and then whatever WDV comes, that WDV you compare with the sale consideration. Suppose employer charged you something, then compare with that. Employer did not charge anything, then compare with 0. Suppose example, 1 lakh worth computer the employer purchased and he used it for 2 years. So now let's calculate depreciation. For computers it is 20%. For motor car, sorry, computers it is 50%. Motor car it is 20%. Okay. So suppose 1 lakh computer, 2 years it is used. So first year 1 lakh depreciation is 50,000, right? And then what would be the WDV for the second year start? 50,000. 1 lakh minus 50, so 50. Then again depreciation 50% of 50,000, so 25,000. So WDV after second year is 25,000 only. 50 minus 25, 25. Now if the employer charged to the employee, suppose 5,000 rupees, then the WDV is 25 given to employee for 5,000. So 20,000 becomes your taxable perquisite. This is how you should do with computers and also the motor car. But computer rate of depreciation WDV is 50%. For motor car it is just 20%. What about other assets? Like if employer give fridge, TV, washing machine, right? Then how to value? The answer is quite simple. 10% should be the depreciation on straight line method. What I said? 10% is the rate of depreciation on which method? Straight line method. So every year fixed depreciation if it is other assets like TV, fridge, washing machine. Okay. So suppose employer purchased the washing machine for suppose 50,000 and after 3 years the employer gave it to the employee for just 10,000. So for 3 years how much depreciation? Right? 3 years how much? 10%, right? 50,000 into 10% how much? 5,000. So each year 5, 5, 5, 3 years over 15, correct? So 50 minus 15, 35 will come and given to the employee for 10,000, right? So 35 minus 10, 25,000 will be taxable perquisite. So what I wanted to convey that if it is other assets, then straight line method you should follow for calculating depreciation, that too at 10% only. If it is computer 50%, if it is motor car 20%, but at WDV method. Suppose if the asset is held by the employer for 10 years or more, if the asset is held by employer for 10 years or more and after that it is given to the employee, in that case it is not a benefit to the employee. Zero value of perquisite. Perquisite value will be 0. Okay, let's continue forward. Now what I wanted to convey that we understood something about gift. We understood about usage, right? We understood about transfer of movable assets. Now let's try to actually understand if it is other perquisite. Now whatever I discussed, you leave it. Something unique is given. Then simply remember the fair market value of the benefit to employee minus recovered from employer. Oh, sorry, recovered from employee. So whatever employer gives the benefit to employee, what is the fair market value of it? Minus what is recovered from the employee. Once you deduct that, you will get the real value that is taxable. ओके नाउ लेट्स कम टू लीव ट्रैवल कंसेशन. बहुत पढ़ लिए भाई, आप छुट्टी मनाते एंजॉय करते ट्रैवल करते. जस्ट एग्जाम्पल के लिए, एक्चुअली मत छोड़ के जाना वीडियो, राइट? सो व्हाट आई वांटेड टू टेल, लीव ट्रैवल कंसेशन. व्हेन यू एक्चुअली जॉइन द जॉब, you are continuously monotonously working throughout the years. Sometimes you really get tired of the job, get frustrated. So what employers do, that they give sometimes leave travel concession. We are giving you leave, you go, travel, enjoy and come back. So such leave travel concession benefits are given. So there is a block of 4 years, right? And that too they are calendar years. Please remember that they are calendar years. Like 2022, 23, 24, 25 is a block. These 4 calendar years become one block. So in this 4 years block, 2 leave travel concessions can be given by the employer, and income tax is ready to give the exemption on it. Now to whom that exemption is given? Self, spouse and children. Right? To whom it is given? Self, spouse, children. Right? So like that they can get the benefit. But how many children? Only 2 children. Okay? But you may ask me, sir, if the second time when the child is born, it is not single but it is twins, then okay, the third child is also okay. That means 3 children they will get. Sir, but first time only twins, then the first time 2 kids will be given the benefit of exemption. The third child will not get the benefit of exemption. So ultimately, how many kids will get the exemption, leave travel concession benefit along with employee? Only 2. But only in case when the second time childbirth is not single but twins, then only even the third child will get the benefit. So self, spouse and children, 2 children will get the benefit. How many travels? In a block of 4 years, like 2022, 23, 24, 25, block of 4 years, 2 times travel can be done. So suppose 18, 19, 20, 21, these 4 years is one block again, right? Like this, in a block 2 times you can travel. Now here benefit is given for travel but not for accommodation or food, only for travel. Employer may pay for travel, accommodation, food, everything, no problem. Let employer pay. But accommodation and food facilities are fully taxable. Only travel is exempted, that too to some extent. Now what is the extent of exemption? Simple. If you are traveling by air, up to economy class is exempt. Suppose employer gave you business class tickets, no problem. Business class ticket 50,000 rupees, economy class ticket 5,000 rupees, 45 is taxable. Right? So up to economy class airfare is fully exempt. If you are traveling by train, then first class AC fare is exempt, and if some extra facilities are there, then that would be taxable. Suppose you are traveling by any other mode, then ask a question. Are you connected by rail? If yes, then whatever rail fare is there, first class AC fare of rail, that much is exempt, balance is taxable. Suppose example, you are traveling by bus from Hyderabad to Pune, the bus charges you something around 1500 rupees and first class AC fare of train is 1000 rupees, 500 is taxable, right? Next thing, suppose you are traveling by bus which is not directly connected by rail. Suppose I am going from Hyderabad to Goa, directly not connected by rail, I am going by bus. In that case, is recognized transport system is there, like government, right? Government is the only recognized thing, right? If government transport system is there, whatever deluxe fare of the road transport vehicle is there, that will be exempt and balance is taxable. But sir, if there is no recognized public transport system, no government transport system, then don't worry, for similar distance, how much would be the fare of railways? Up to that amount exempt, balance is taxable. So are you clear? By air, up to economy class exempt. By train, first class AC fare is exempt. By any other mode, then if it is also connected by rail, then only trains first class AC fare is exempt, balance is taxable. If it is not even connected by rail, then recognized public transport system is there or not? If yes, a recognized public transport system is there, government transport system is there, first class deluxe fare is exempt and balance is taxable. If recognized public transport system is also not there, for similar distance, how much the railway charges, that much is actually exempt and balance is taxable. This is what we should understand. So leave travel consists just a theoretical topic, that's why I recapped. Revise for all of you, and shall we go to medical facilities? Are you all ready? Right? Ready. Great. So we completed 4 points. Still there are some more points to discuss. So let's continue with 5 points I covered. So still 5 things to discuss from my side. Now I am going to talk about medical facilities. If medical facilities, medical treatment of patient. Now which patient? Self, spouse, children, dependent brother and sister, and dependent mother and father. What I said? Self, spouse, dependent brother and sister, right? Dependent parents and children. So basically, hum do, hamare do, that's okay. Medical facilities are exempt to some extent. Brothers and sister dependent, parents dependent, then exemption is given. So where the treatment is, if it is in employer's own hospital, fully exempt. If the treatment, whatever employer spends on the medical treatment of the employee or family members, fully exempt if it is in employer's hospital, central government hospital, state government hospital, local authority hospital, totally exempt if the employer pays. Okay, but if it is not amongst the above categories what I said, then what to do? Then the simple answer is that is the disease whatever for which the treatment is, like cancer, TB, so is it a specified disease? And is that hospital recognized by CBDT? You have to check with these two criteria. If the hospital is recognized by CBDT, right, and second thing what I said, that it is a specified disease, right? If both the criteria are satisfied, then the treatment is fully exempt. Are you clear with it? Yeah. Medical insurance premium paid by the employer for the employee is fully exempt. Group insurance premium paid by the employer on the life of the all the employees together is fully exempt. This is how you should understand, right? And whatever I said is exempt, and all other medical facilities are taxable, right? Beyond the exemption limit, there is nothing called as beyond, either it is exempt or not exempt, such type of concept this is. So you have to remember that if it is not exempt, then it is fully taxable in case of medical facilities. Okay, so whatever I discussed from Indian perspective. If the treatment is in India, there are people like Sonia Gandhi who go outside India for medical treatment. Nothing wrong with it. If they don't trust doctors in India, which they created in last 70 years, then no problem, it's their choice. But when they go out for treatment, what is the exemption given? So there are three things actually to say. First one, travel outside India. Second one, stay outside India. Third one, treatment outside India. So shall I talk about treatment and stay first? Okay. If it is treatment of the patient or stay of the patient plus one attendant, what they said, up to the RBI prescribed limit is exempt. Up to what limit? RBI prescribed limit is exempt. Beyond that it is fully taxable. Okay. So what I spoke about, medical treatment, and second one, what is it? Stay. Okay, of patient plus one attendant only. If it is second attendant, third attendant, fourth attendant, then that extra is fully taxable, right? Travel and stay and treatment you understood. What about travel? If your salary is up to 2 lakhs rupees, then travel is fully exempt. 2 lakhs per annum. If travel salary is up to 2 lakhs per annum, stay is fully travel is fully exempt. If your salary is more than 2 lakhs, then travel is fully taxable. Now what is the definition of salary for the purpose of travel? So all the basics, bonus, commission, fees, dearness allowance, right, all the allowances, all the perquisites, including the taxable treatment, including the taxable stay, that is beyond RBI limit, all you include, and then check if the salary is less than 2 lakhs, travel is fully exempt, and less than 2 lakhs per annum, travel is fully exempt. If not, then travel is fully taxable. That's how we should remember the topic. Now, are you all ready? The most important and awaited topic, that is provident fund, we are going to discuss now. So let's start with provident fund. What is provident fund? In simple language, I'll tell you, for your retirement benefit, if financial planning is done, you are contributing every month from your salary some amount, employer is contributing some amount, both together will be kept in some fund, right, which is maintained by Central Board of Trustees or any other body, then all that which will be useful for your retirement benefit, this is what the concept of provident fund. How many provident funds are there in India? There are 4 provident funds. First one is statutory provident fund. In simple language, it is created by government for government employees only, right? Second one, the public provident fund. Now those people like me who are unemployed, no, unemployed, self-employed, whatever you can say, no problem, but if you are a person who is not working, or if you are not working under any company, you are self-employed, you are a professional, you are a businessman, in that case public provident fund will be there, where you can contribute yourself for your retirement benefits. This is public provident fund, right? Here there is no employer in public provident fund case. Third one is employees provident fund, that is basically recognized provident fund, we can call, right? EPF, employees provident fund, or we can say RPF, recognized provident fund. Now many government and private organizations actually maintain such fund, and this is the most common fund which is maintained. There is a law called as Employees Provident Fund and Miscellaneous Provisions Act 1952. Are you clear? Yes. So under that act, the top body being the Central Board of Trustees maintain huge lakhs of crores of rupees of all the employees and help them for their retirement planning. So this is government recognized one. And the fourth category is unrecognized provident fund. How the treatment should be, let's see the table and let's try to understand. Now treatment I don't want to discuss in so much minutest level. It is revision, so I'll try to sum up fast. Are you all okay with it? Now generally I'll combine two things. One is statutory provident fund and second one is public provident fund. These both are covered under section 10 subsection 11 actually. So that's why we'll cover these things together. Okay. What one thing I want to tell to you. First thing, if employer contributes to to statutory provident fund, that is government, right? So fully exempt. Public provident fund, there is no such contribution, right? So if employer contributes to the statutory provident fund, it is fully exempt, and no such concept exists in public provident fund because it is for self-employed people. If suppose employee contributes or you own contribute for your provident fund, then you will get deduction under 80C, right? Whatever employee's contribution is there, on that you get deduction under section 80C, right? Third thing which I have to tell you, suppose you get interest on the provident funds, what to do? They are fully exempt. They are fully exempt. I have to change my words, but as of now I am telling it is fully exempt. Let's come to the fourth thing. If withdrawal happens, withdrawal is also fully exempt. In both the cases I am talking about. That's why I combined these two and remember. Okay, what I was talking about, two things, statutory provident fund and public provident fund. In statutory, government is the employer, and in provident fund, public provident fund, you are your boss. So in statutory provident fund, if employer contributes, it is not taxable, it is fully exempt. Public provident fund, no such concept exists. In both the cases, if employee contribute, then 80C deduction can be availed. Interest you earn in both the cases, they are fully exempt. Withdrawal is also fully exempt in both the cases. That's what I wanted to convey. Now shall I do one thing for you? Shall I discuss totally about unrecognized provident fund first and then come to recognized provident fund? Are you all okay? Yes or no? Yes, I feel. So let's continue. In case of unrecognized provident fund, because it is not recognized, employer's contribution is fully ignored. Employee's contribution is fully ignored because when it is not recognized by CBDT, the employer may show records, may not show records, right? So government says one thing, till your fund becomes recognized, we are going to ignore you. That's it. So that's why employer's contribution, employee's contribution, interest on such contributions, all are fully ignored. Not exempt, ignored is the right word. And last thing, when the money is withdrawn, what happens? Let's try to understand. You see below the table is employer's contribution and interest on employer's contribution. So there are four components when you withdraw the money. One is employer contributed the money. Second one, employee contributed the money. Third is interest on employer's contribution. Fourth one is interest on employee's contribution. Correct? Four things I said. First, employer's contribution. Second one, employee's contribution. Third one, interest on employer's contribution. Fourth one, interest on employee's contribution. Four things. In the four things, employer's contribution and interest on it, both are taxed under salary. At the time of withdrawal, that entire lump sum amount which already employer has contributed till now and whatever interest accumulated on that, both will be taxed under the head salary when you receive in lump sum because it is URPF. Okay. Second point, if suppose employee's contribution is there, his salary was already taxable, right? Then why should you again tax the contribution from that salary? So employee's contribution is ignored, right? He neither got the 80C deduction, but now when lump sum is there, anyhow they are not troubling the employee, his contribution is exempt. But interest on employee's contribution is taxable under the head other sources. Interest on employee's contribution is taxable under other sources. I am talking about, yes, URPF, unrecognized provident fund. Employer's contribution and I am talking about URPF, unrecognized provident fund. I already said employer's contribution, employee's contribution, interest on it, all are ignored. But at the time of withdrawal, whatever employer contributed and the interest on it is fully taxable, and whatever employee contributed is ignored, but interest on employee's contribution is taxed under income from other sources. This is what we should actually learn. Remember, small questions can be asked from MCQ type or some small 4 marks questions, so be prepared. You want to solve problems on these topics with me, you can actually check another video on Provident Fund. There I have discussed some problems which are specifically based on amendments also, so it would be useful for you. Next thing, what about recognized Provident Fund? Employer's contribution up to 12% is fully exempt. Kya bola main? I am talking about recognized Provident Fund, that is employees Provident Fund based on the Employees Provident Fund and Miscellaneous Provisions Act 1952. So employer's contribution up to 12% is fully exempt, beyond that it is fully taxable. 12% of what? Salary. Employer's contribution up to 12% of salary fully exempt, beyond that it is fully taxable. Salary means what? Basic pay, DA, retirement plus commission as a percentage of turnover. What I said? Basic pay plus DA, retirement plus commission as a percentage of turnover. In CMA course, if they don't tell that it is DA, retirement, assume that it is. If they specifically tell it is not forming part of DA, then, or it is not forming part of retirement, then ignore it. Okay, then don't take such DA here. So basic pay plus DA, retirement plus commission as a percentage of turnover. So in the question they should tell you these are the sales and this is the percentage of commission. Okay, then only you take. If they say commission 5,000, don't take it. They say commission 10,000, don't take it. It should be like percentage plus sales. Then you calculate and take, right? So basically employer's contribution up to 12% is exempt, beyond that it is fully taxable. 12% of salary, I said salary is equal to basic pay, DA, retirement plus commission as a percentage of turnover. Employees contribution as usual, ATC deduction. Interest on employer and employees contribution up to 9% it is, oh sorry, up to 9.5% it is fully exempt, and beyond that it is fully taxable. What I said, up to 9.5% it is fully exempt, beyond that it is fully taxable. Up to 9.5% it is fully exempt, beyond that it is fully taxable. Interest I am talking about. Actually in the past government gave 14%, 16% interest. That's why it was taxable at that time, beyond 9.5. Presently government is given 7.98% something. So whatever interest you are getting is fully exempt. Interest above 9.5% is fully taxable, up to 9.5% is fully exempt. Now at the time of withdrawal what will happen? Right? This is what special thing. If you are withdrawing from recognized provident fund, your focus is there on the notes, right? If you are withdrawing from the recognized provident fund, then you have to see the note number 2 I feel, and see it in detail. First thing, if you generally withdraw after 5 years of continuous service, then the withdrawal from recognized provident fund is fully exempt, not at all taxable, if it is after 5 years of service, right? If you are withdrawing before that, then is it because of your ill health? Is it because your business is closed down, the organization in which you are working? Is it because you are shifting to another company? There also there is something called as EPF and your accounts are shifted there. Are you actually converting from EPF to new pension scheme? Or is it a case where which is not in your control, beyond your control? If any of these reasons are there, then fully exempt. In all other cases, treated as URPF. So again I am repeating, please remember, I am talking about recognized provident fund. You know, employer's contribution every year up to 12% exempt, beyond that it is taxable. Employees contribution, ATC deduction is given. Interest on the contributions up to 9.5% exempt, beyond that taxable. Withdrawal, I said after 5 years of maintaining the fund, if you withdraw it is fully exempt. But if you withdraw within 5 years also, because of ill health, because the business closed, because you are shifting to another organization where there is EPF also, you are shifting to another organization where there is NPS, you are switching to NPS account, you are actually closing down the account because of the reasons which are beyond your control. In all these cases government says we are with you, don't worry, fully exempt. But if it is not covered in all these cases, then the withdrawal is fully taxable. But how it is fully taxable? Same like URPF. Same like URPF. That means employer's contribution and interest on it is fully taxable under the head salary. Employees contribution is not considered, but interest on employees contribution taxable under other sources. Same will apply to RPF as we discussed in URPF. Done? Yeah. If this would have continued like this, many people, rich people like Ambani would be very happy, because they get salaries of suppose 1 crore per month, up to 12 lakhs is fully exempt. Employer laga diya, right? Employer gave 12 lakhs, it is fully exempt, right? So they enjoyed the privilege till now. But Modi government, right, they simply said अमीरों से लूंगा और गरीबों को दूंगा. So that concept continues. They said that if you are contributing to listen carefully, listen carefully. If you are contributing to something called as employees provident fund, right, who is contributing? Employer, plus new pension scheme, plus superannuation fund. What I said? Employees provident fund, second one new pension scheme, or third one superannuation fund. If the contribution in a year by the employer exceeds 7 lakh 50, how much? Exceeds 7 lakh 50. इधर भी पैसा दे रहे, उधर भी पैसा जमा कर रहे, उधर भी पैसा जमा कर रहे, एंड यू से एग्जेम्प्ट एग्जेम्प्ट एग्जेम्प्ट, तो चलेगा क्या? राइट, गवर्नमेंट शुड गिव एग्जेम्पशन टू सम एक्सटेंट, नॉट मोर. So that's why government said, okay, in a year up to 7,50,000 in aggregate from all the three funds, that is employees provident fund, superannuation fund, and last one is भूल गया ना, new pension scheme. Up to 7,50,000 contribution by the employer is exempt, and beyond that it is taxable. And beyond that it is taxable. Now you may be thinking, sir, if the contribution is more than 12%, anyhow it is taxable, right? But if the employer's contribution is more than 12%, it is anyhow taxable. But think about Mukesh Ambani's salary, 1 crore salary per annum समझो example के लिए, 12% will become how much? 12 lakhs. Exempt करेंगे ना? Government said that 7,50,000 is exempt, babu. More than that, 7,50,000 to 12 lakhs, how much? 4,50,000. 12 lakhs minus 7,50,000, so 4,50,000 will come. That 4,50,000 is taxable. 4,50,000 is taxable. 4,50,000 is taxable. Are you able to connect with the dots? Yes or no? I feel yes. With all the enthusiasm, with all the focus, you understood. Now what the government came up, now this is effective from 1st April 2020. What I said, up to 7,50,000 of all the three together contribution is exempt, but more than that is taxable. This rule was brought from 1st April 2020, right? But government also said not only that, but interest also we are giving exemption, right? Up to 9.5% exempt. So totally exempt anyhow, because government gives just 8%. So government said that if interest earned on funds deposited by employer up to 7,50,000, interest is also exempt. But beyond 7,50,000, you are contributing, that extra amount is also taxable, interest on that is also taxable. Suppose Mukesh Ambani's salary is 1 crore rupees per annum, 12% comes to 12 lakhs, right? Suppose I'll tell you that employer, that is Reliance Industries, is giving 14% to Mukesh Ambani. Let's assume like this. Then what will happen? 1 crore into 14%, 14 lakhs. That extra 2 lakhs, that is 13th lakh and 14th lakh, 2 lakhs, are anyhow taxable based on the basic things which we discussed, right? But up to 12 lakhs also, what government said, that up to 7,50,000 exempt, and 7,50,000 to 12 lakhs, that is 4,50,000, is taxable provident fund contribution. Now on this 4,50,000, any interest earned, that interest is also fully taxable. Interest is also fully taxable. Interest on contribution by employer up to 7,50,000 is exempt. Interest on contribution by employer beyond 7,50,000, whatever amount is there, on that interest is there, that is fully taxable. Clear? But how to calculate, sir? I'll tell you how to calculate. There is a formula called as TP is equal to PC by 2 into R plus PC1 plus TP1 into R. Now when I say ये TP क्या है, PC क्या, you just see the formula, I'll explain. Now I am only talking about taxing the interest, and if they invested in shares, dividend also. Okay. So the taxable perquisite which I said, TP, is nothing but that interest and dividend which is taxable. Okay. Is equal to PC by 2 into R. Now what is PC? PC is the principal contribution which is taxable. So I can say whatever is more than 7,50,000, that is PC by 2 into R. R is the rate of interest. Okay. Plus PC1 plus TP1 into R. Now what is PC1 plus TP1 into R? R is return, right? So how much is the return on the investment you are going to earn? That is R. It may be interest or dividend. But you may be thinking, what is PC1? Let me tell you with example. 2021-22 is the previous year. 21-22 is the previous year for our understanding. Right? 21-22 is the previous year for our understanding. In 21-22 I said PC word. Okay? PC is for 21-22. So PC 21-22 taxable contribution divided by 2 into R plus PC1. This rule was brought in 2020, right? From 1st April 2020, right? I said yes or no? So 2021 is only 1 year, right? That 1 year's taxable contribution is PC1. And in that year some interest would have also been taxable, right? That is TP1, right? So 2020-21's principal contribution which is taxable is PC1 and interest taxable interest is TP1. These two will be totaled into R. That's what we have to do. So what is the formula you have to apply? TP taxable perquisite for the previous year 21-22 is equal to PC by 2 into R plus PC1 plus TP1 into R. This is what we have to do. Right? If you apply this formula, you will be able to solve the problem. Now, how we get R, that is very important for you, that I will tell you. R is equal to I by F AVG. R is equal to I by F AVG. I is nothing but interest and dividend income, and divided by FEVG means what is the opening balance of the provident fund, or right, provident fund, and what is the closing balance of provident fund, or in simple language I'll tell, on 1st April 2021 of the previous year, what is the balance to the provident fund, superannuation fund, NPS, plus on 31st March 2022 what is the balance of provident fund, superannuation or क्या था NPS, divided by 2 is the FAVG. Right? All these data you will get in the question and happily you can solve the problem. Still, if you did not understand, you can actually do the problem with me on the video on provident fund which I will give in the description. Okay? With this, we understood about provident fund. One small thing, in 2021, on 1st April 2021, till now we are all thinking about taxing employer's contribution and interest on employer's contribution, correct? But what about employee's contribution? He can also contribute more, right? So government said no problem, up to 2,50,000 of employee's contribution is fully exempt, but beyond that is a taxable contribution. Wrong. What is right? Up to, देखो, employee's contribution he is putting from his pocket, correct? So that's why it cannot be taxed. But what government said, that interest on employees contribution, that contribution may go up to 2,50,000. If up to 2,50,000 employees contribution is there, on that interest is fully exempt. But if the contribution goes beyond 2,50,000, on that interest is taxable. Suppose employee contributed 4 lakhs. So employee's contribution of 4 lakhs is anyhow fully exempt. But what about interest on 4 lakhs? They said interest up to 2,50,000 on the amount of 2,50,000 contribution is fully exempt. But beyond that, 4 lakhs minus 2,50,000, on that 1,50,000 whatever interest actually is earned, right, that is fully taxable. So this is employees contribution done. Now let's continue with standard deduction. This I feel you understood. Let's come to standard deduction. Only 3 deductions are there. Standard deduction, how much? Actual amount, whatever is the gross total gross salary, what is the gross salary, or standard amount 50,000 rupees, whichever is lower is allowed as standard deduction. what I said, gross salary or rupees 50,000, whichever is lower is allowed as deduction, standard deduction. Okay. Second one, entertainment allowance. Entertainment allowance for non-government employees is fully taxable, and for government employees also fully taxable. But government employees, only government employees, including statutory corporation employees like LIC, ONGC, they also get the benefit of deduction under section 16 subsection 2. Only government employees, state or central or even statutory corporation employees get deduction. So private non-government will not get any deduction under section 16 subsection 2. Okay. So when you think about entertainment allowance, always remember it is fully taxable. So whatever entertainment allowance is there, directly you write in the solution, right, for calculating gross salary. But if it is government employee, then give deduction after the gross salary here. So what is the deduction? Least of the following three. What is the deduction? Least of the following three. First one I am going to talk about actual allowance. Second one, 20% of the salary. Arey, salary nothing but basic pay re baba. Salary nothing but basic pay. And third one is 5,000 rupees. So what are the three things? Entertainment allowance deduction under section 16 subsection 2, and what we discussed, that least of the following three is allowed as deduction: 20% of basic pay, rupees 5,000, or actual allowance, whichever is lower. Now how much you actually spent or not is not considered here. Okay, clear. Now come to the last point, that there is something called as professional tax or employment tax. This is a very nominal amount, like 200 rupees is charged in Telangana. What I paid, actually I am telling, per month. Okay, and this 200 rupees which is paid to the state government, that is called as employment and professional tax. State to state it may vary, right? So basically what it is, a tax paid to the state government because you are doing job here. So that is allowed as deduction. Many a times in the question they give that professional tax or employment tax paid by the employer. If it is paid by employer, it is a taxable perquisite. So show it as taxable income, and then you can claim deduction under section 16 also. Okay. But if employee pays from his pocket, then claim the deduction but don't tax it. That's it, to get the net salary. So I hope you actually enjoyed every part of the discussion what we tried to. Sorry for the delayed uploading of this video, but yes, we are putting all the efforts to make the things faster, to help all of you so that you can grow in life and continuously focus on learning, growing in life. And yeah, connect with YouTube channel, subscribe, share, right? Sharing is caring. So we'll meet in the next lecture on PGVP amendment. So many things are going to come in future. So stay connected.